guys, welcome back to Tax Q&A. These days, it is quite common for people to move abroad, whether it's for work, higher studies, or simply better opportunities. However, once you do so, you are no longer residing in India and hence you become non-residents. And that changes how you're taxed here. See, the tax rules and even compliances for NRIs are different from those for resident individuals. And at times, it can get a little confusing, especially when you're living abroad but still have financial ties back home. So in today's video, we'll cover everything about NRIs and their taxation in India. Let's get started. Of course, this naturally becomes the first question. Now, just because you take a flight to the US today doesn't mean you become an NRI tomorrow. Your residential status is actually based on how many days you have been in India during the financial year. To figure that out, you need to ask yourself two questions. Have you spent 182 days or more in India during the year? Or have you spent at least 60 days in the current year and 365 days in total over the last 4 years? If the answer to any of these questions is yes, you will be considered an Indian resident. But if the answer to both of these questions is no, you are an NRI and you should watch this video till the very end. If you are earning any kind of income that originates from India, then yes, you are expected to file an ITR. Even if that income is below the basic exemption limit, it is always a good idea to file the ITR, as you can then claim a refund of the TDS that was deducted. So once you move abroad, you can't just keep using your regular savings account in India. You will be required to convert it either to a NRE or NRO account, and hence this question. Now, NRE stands for non-resident external account. This account is for your foreign income, say salary earned abroad that you want to bring to India. The money is held in rupees, but both the principal and interest are fully repatriable. This means you can transfer the entire amount anytime back to the overseas account without any restrictions. Plus, the interest that you earn on this account is tax-free in India. Another type of account is NRO, which is non-resident ordinary account. This is generally used for the income you earn within India, like rent from property, dividends, or pension. The money is also held in rupees, but it's not fully repatriable and is subject to certain limits. Also, the interest earned on the account is taxable in India. Alright, to begin with, only your income that is earned or accrued in India is taxable here. If you're earning a salary abroad or say have investments outside India, that income neither needs to be reported nor it is taxed here. But any income that has its source in India, like rent from property located here, interest from NRO accounts, capital gains from Indian stocks or mutual funds, that is where the Indian tax rules come into play. Now in terms of tax rates, NRIs are broadly taxed in the same way as residents. Income like rent, business or profession, or income from other sources are taxed at slab rates. Capital gains, whether from shares, mutual funds, or real estate, are taxed at special rates, just like they are for residents. The rates will vary based on the asset type and holding period, and for that you can refer to this table. You can take a screenshot for your reference as well. But then, what changes for NRIs? 1. You don't get the rebate under Section 87A. This is the one where residents with income up to 12 lakh under new regime can get a full tax rebate. As an NRI, this benefit does not apply. You'll have to pay tax if the income exceeds basic exemption limit, which is 4 lakh under the new regime and 2.5 lakh under old. 2. You don't get the basic exemption on income that is taxed at special rates. So say you have made a capital gain of 30,000 on Indian stocks. As a resident, that amount can be ignored if it's within the exemption limit. But for NRIs, it will be taxed. And 3. Pretty much every income that you earn in India is subject to TDS, which is tax deducted at source. In many cases, the rate of TDS can be higher than your actual tax liability as well, which is why filing your ITR also becomes important, not just for reporting your income, but also claiming a refund in case excess tax has been deducted. Most types of income that you earn in India are subject to TDS right at the source. So whoever is paying you, whether it's the tenant, a company, a buyer, or a broker, they are the ones responsible for deducting the tax before the money even reaches you. Now the TDS rate depends on the type of income. For example, if you're earning long-term capital gains from listed Indian stocks or equity mutual funds and ETFs, TDS is deducted at 12.5%. If it's short-term gains, the TDS rate is 20%. Your broker deducts this at the time of settlement. Similarly, if you sell a property in India, the buyer is responsible for deducting TDS. The TDS rate is 12.5% for the entire sale value. So say you sell a house for 1 crore, the buyer deducts 12.5 lakh as TDS, even though your actual tax liability might be much less. For instance, say you bought the property for 70 lakh. So your gains become only 30 lakh and the actual tax due will be 3.75 lakh. But since 12.5 lakh has been deducted, you will have to file the ITR and claim the rest of TDS as refund. Here's a table to sum up the TDS rates. Do remember, at times the payer may deduct TDS at a slightly higher rate because they'll also include a 4% cess on the tax amount. Also, the deductor then deposits the TDS to the government on your behalf. Make sure they also file Form 27Q, which is a TDS return form used for payments made to NRIs. We just saw how TDS applies to almost every income that an NRI earns in India. And not just that, the rates are also quite high. Now, if you don't have taxable income here, this TDS ends up blocking a good chunk of your money even when your actual tax liability is low or even nil in some cases. In such cases, you can apply to the Income Tax Department for a lower TDS certificate under Section 197. This certificate basically tells the payer to deduct TDS at a reduced rate or sometimes not at all based on your income. You start by filing out Form 13, which you submit online via the Traces portal. You need to provide details like your estimated income, tax liability, and supporting documents as well. If they are satisfied, they'll issue you a certificate and you can then hand it over to whoever is making a payment to you, like a buyer, tenant, or your bank. From there on, they'll deduct TDS at the lower rate mentioned in your certificate. So, just like residents, NRIs too can choose between the two tax regimes. The new regime comes with lower slab rates but no deductions, while the old regime allows you to claim deductions like ATC, ATD, interest on home loan, and so on. Now, under the new regime, residents earning up to 12 lakh can claim a tax rebate under Section 87A, which brings their tax liability down to zero. But as an NRI, you don't get this rebate. So, you pay tax as soon as your income exceeds 2.5 lakh under old regime and 4 lakh under the new one. So, if you don't have too many deductions to claim or your income is on the higher side, the lower tax slabs of the new regime may work out better. But if you're someone who's investing in ELSS funds, NPS, paying insurance premiums, home loan interest, etc., and your taxable income isn't very high, then the old regime could offer better savings. And yes, NRIs can claim most Chapter 6A deductions like investments in ELSS funds, PPF, life insurance premiums under Section 80C or health insurance premiums under Section 80D. You can see the list of deductions on your screen and take a screenshot for future. Just remember, you can't open a new PPF account as an NRI, but if you had one from your resident days, you're allowed to continue contributing to it until maturity. In case of NPS though, you are allowed to open a new account and invest even after becoming a non-resident. There are certain exemptions available for NRIs if they have long-term capital gains. Number 1 is exemption under Section 54. This one applies when you sell a residential property and reinvest the capital gains into another residential property in India. The new property has to be purchased within a specific timeline, either within 1 year before or 2 years after the sale, or constructed within 3 years. If you meet the conditions, you can claim full or partial exemption. Then comes Section 54F. This one's useful when you're selling long-term capital assets other than a house, say land or shares, and reinvest the entire sale amount into another residential property in India. The key difference here is that you have to reinvest the entire sale proceeds, not just the gains, to get full exemption. If you don't want to reinvest in a property, there's another option. You can invest the capital gains up to 50 lakh rupees in 54 EC bonds, like those issued by REC or NHAI. These need to be bought within 6 months of the sale and come with a 5-year lock-in. Just keep in mind, this option is only available if the asset you sold was a land or a building. Yes, NRIs too are required to pay advance tax. If your total tax liability for the year exceeds 10,000, you're supposed to pay it in installments across the year. Now in many cases, TDS already gets deducted on your income, especially if you're earning interest, selling property or investments. But if your total tax due is still above 10k after reducing TDS, then you have to calculate and pay advance tax. Yes, as an NRI, you can claim the benefit of DTAA, that is Double Taxation Avoidance Agreement, to make sure you're not taxed twice on the same income. Let's say you earn interest from an NRO account in India. Now this interest is taxable in India, but it may also be taxed again in the country you live in. In such cases, you can get a relief in two ways. Exemption method, where one country agrees to completely exempt that income from tax, and tax credit method, where you pay tax in India and your country of residence gives you credit for the tax while calculating your tax liability. Lastly, the DTAA rules differ from one country to another, so you'll have to check for those applicable to your country of residence. And with that, it's a wrap. If Google search is too much work for you, Quora is full of opinions, then you should check out Tax Q&A, where you can toss questions and our tax experts give quality answers. And hey, don't forget to like and subscribe so you do not miss out on what's coming next. Catch you in the next one. Depends how much money you're willing to put. Yes, as an NRI. Oh, Karkash Mani. खा ले पहले. Some shady thing the producer has. एक बेरहम producer गया, दूसरा गया. लगा भाई लगा. 1 rupee for every second delay. I was saying loan दूंगी. I already have a few clients in mind. यही कमी थी. आजा आजा भाई आजा. तू भी आजा. ऐसे खड़े होके देख उधर.